Welcome, brilliant minds, to the deep dive.
Great to be here.
In our information-saturated world, it often feels like we're just adrift, right? Trying to figure out what's trustworthy, what really matters.
And how to get to the core of complex topics quickly without getting lost in the noise.
Exactly. So what if you had a trusted guide, maybe a shortcut, to understanding the most important insights without getting bogged down?
Well, that's precisely our mission today.
Indeed. We're about to embark on a deep dive into the fascinating, sometimes hidden, world of auditing.
And forget the stereotypes, the dry numbers and dusty ledgers. This is really about the meticulous, almost detective-like methods auditors use.
Detective work. I like that.
Yeah.
Methods they use to build and maintain trust in, well, the bedrock of our economic system, financial information.
It really is foundational.
So our goal for this deep dive is to unravel the core procedures auditors employ to gather their evidence.
We're going to try and demystify these powerful techniques, revealing not just what they are, but, more importantly, why they are so indispensable for anyone who relies on financial reports.
Think of it as gaining an insider's understanding, how financial truth is actually verified.
And our source material for this is the gold standard. We're looking at excerpts from professional auditing guidelines.
These aren't just academic texts, they're the actual playbooks auditors use daily to do their jobs.
It's like getting access to the confidential manual of financial verification. Pretty neat stuff.
It really is.
Yeah.
So by the end of this deep dive, you'll possess a far clearer understanding of how auditors operate, what truly underpins trustworthy financial information.
And maybe even how to apply some of this critical thinking in your own professional or even personal life.
Get ready to gain knowledge quickly, thoroughly, and maybe have a few genuine aha moments. Let's start digging.
Let's do it.
All right, let's unpack this. Imagine an auditor not just as a number cruncher, but as a highly skilled strategic detective.
That's a great inclusion.
Every financial statement they encounter is like a complex mystery, right? Waiting to be meticulously solved.
And like any top investigator, they don't just guess or take things at face value.
No. They possess a specialized toolkit brimming with procedures specifically designed to gather conclusive, persuasive evidence.
And our source material even provides a clever mnemonic to help us remember some of these core tools. 5 carat wars.
5 carat wars. Okay, I'm intrigued. And we'll decode each component as we go, understanding not just the action, but a strategic purpose, too.
Exactly. And that mnemonic, it's surprisingly effective, isn't it? It helps demystify what can initially seem like this overwhelming array of procedures.
Definitely helps organize it. So what's first? The F in 5.
Right. The F represents footing, cross-footing, and recalculation. At its heart, this is all about verifying mathematical accuracy.
Okay, basic math checks.
It's the foundational check, really, making sure the numbers truly compute.
So if I understand correctly, footing is just summing numbers down a column, like checking the daily sales total.
Precisely. Adding down a column.
And cross-footing would be summing across rows, making sure things add up horizontally, too.
Yep. Checking consistency across. It sounds basic, but you'd be surprised.
I imagine even simple math errors can hide bigger problems, or at least distort the picture.
Exactly right. While it might seem straightforward, mathematical accuracy is absolutely paramount. Even in complex financial reports, if the basic math is off, the entire picture can be skewed.
So what about recalculation? How's that different?
Well, recalculation elevates this a bit further. Here, the auditor independently performs computations that the company initially made themselves.
Redoing the work themselves.
Right. For instance, recalculating a company's depreciation expenses on its assets to ensure it aligns with their stated accounting policies.
Okay.
Or maybe independently reamortizing a loan schedule to verify the interest and principal calculations. We're talking about things like accruals, too. Expenses incurred, but maybe the bill hasn't arrived yet.
Right. Estimates.
The auditor will recalculate those estimates to ensure they are reasonable and, crucially, mathematically sound.
That makes perfect sense. It's not just taking the company's word for the final number, but verifying the actual journey to that number.
Precisely.
What tools do auditors use for this, especially with, massive data sets?
Yeah.
I can't imagine this is all done by hand anymore.
Oh, definitely not. Not for large volumes. While smaller, targeted recalculations might still be done manually, for large data sets, auditors heavily leverage automated tools.
Like spreadsheets.
Sophisticated spreadsheets, yes, but even more powerfully, things called generalized audit software packages, or GSP.
GSP.
Okay. These aren't just fancy calculators. They allow auditors to perform really complex data analysis, test entire populations of transactions, identify trends, and catch calculation errors across vast data sets with incredible speed and accuracy.
Wow.
It means that while the concept check the math is basic, the application is highly advanced. It enables auditors to catch misstatements that would be, frankly, impossible to find manually.
That's a critical point. The sheer scale of modern financial data demands these advanced tools. Okay, moving to the I in 5, we have inquiry.
Inquiry, asking questions.
Right. Sounds straightforward, just asking questions, but you mentioned earlier there's an art to it, especially since it's rarely sufficient evidence on its own.
There absolutely is an art to effective inquiry. It involves requesting information from knowledgeable individuals, both inside and outside the organization.
Inside and out, like who?
Internally, this could be key managers, supervisors, people who really know the processes. Externally, it might involve contacting the company's legal counsel, their bankers, or even major customers or suppliers.
What kind of questions?
Well, for example, an auditor might inquire about any pending lawsuits the company faces. That's something you'd ask the lawyers.
Right.
Or they might ask production managers whether specific inventory items are becoming obsolete, losing value. These questions provide crucial context.
And they can highlight areas of potential risk or maybe unusual situations that aren't obvious just from looking at the numbers or documents alone.
Exactly. It helps you understand the why behind the numbers sometimes.
So it's vital for gaining that initial understanding and maybe identifying potential red flags. But you mentioned its limitation. Why isn't inquiry alone strong enough evidence to, say, base an audit opinion on?
Yeah, that's a fundamental principle in auditing. Inquiry alone is generally considered insufficient audit evidence.
Why is that?
Because, well, it's essentially taking someone's word for something. People might be biased, they might not fully understand, or in rare cases, they might intentionally mislead.
Okay, so it's a starting point.
It's absolutely a starting point. It's a way to gather initial understanding and to identify areas that need further, more concrete investigation.
So how do auditors make inquiry effective then?
Well, when using inquiry, auditors have to carefully consider the characteristics of the person they're asking. Their knowledge, their objectivity, their qualifications. Are they in a position to know? Are they unbiased?
Right.
Asking appropriate, pointed, and importantly, non-leading questions is critical. You don't want to suggest the answer.
Good point.
And then, crucially, they must critically evaluate the response. Does it make sense? Is it consistent with other evidence? This often means following up with more questions or maybe modifying other audit procedures based on what they learned.
So it's a dynamic process of discovery really leading to other forms of evidence.
Precisely. It directs the rest of the investigation.
It's like a detective interviewing witnesses. They get leads, but they need the fingerprints, the physical evidence to corroborate.
Perfect analogy.
Which brings us nicely to the VM5 vouching. You describe this as a powerful form of directional testing, moving backward from the financial statements.
Vouching is exactly that. It's a type of directional testing that moves backward. You start from an entry that's already recorded in the financial statements, the final summary, essentially, and you trace it all the way back to the original supporting documents.
Okay, going backward, what's the goal?
The main objective of vouching is to gather evidence that recorded transactions and balances actually exist or occurred.
Yeah.
It's primarily designed to help detect potential overstatement errors.
Overstatement errors. Can you walk us through a practical example? Like, how would vouching work for, say, revenue?
Absolutely. Imagine you see a large revenue entry for a specific sale listed on a company's income statement, or maybe a significant balance in accounts receivable on the balance sheet.
Okay.
Vouching would involve selecting that financial statement entry, the final recorded number, and then pulling the original source documents that support it.
Like what kind of documents?
Like the actual sales invoice sent to the customer, the shipping document that proves the goods actually left the warehouse, and maybe even the customer's original purchase order.
Ah, the paper trail.
Right. The auditor is essentially asking, does this revenue truly exist? Did this sale genuinely occur? Is this receivable real? It's all about ensuring that what's recorded isn't fictitious or somehow inflated.
So it's about proving the reality behind the numbers, protecting against claims of things that just aren't there. Got it. Excellent. The next letter, E, stands for examination or inspection.
Examination or inspection.
This sounds very hands-on, like directly observing or reviewing things.
It is, very much so. This involves the auditor physically inspecting or examining records, documents, or tangible assets.
Physically touching things.
Sometimes, yes. Yeah. This can be done in person, of course, but increasingly, especially with companies having operations all over the place, it can also happen through remote observation tools.
Remote tools? Like what?
Like using drone cameras to survey a vast inventory yard, or maybe using video transmissions to examine specific assets in a faraway location. Technology's changing how this is done.
Interesting. And it applies to documents, too.
Oh, yes. Records can be internal or external, paper or electronic. The power of this procedure really lies in its directness. The auditor sees it or examines it themselves.
And what kind of evidence does this provide most strongly? Does it confirm, say, everything about an asset, like who actually owns it?
That's a really key nuance. While inspection provides strong evidence about the existence assertion, confirming that something physically exists, it's generally less effective for proving ownership, rights, obligations, or even precise valuation on its own.
Can you give an example?
Sure. Inspecting a piece of machinery tells you it exists, and you can assess its physical condition, maybe see if it's rusty or looks broken.
Right.
But just looking at it doesn't necessarily tell you that the company owns it outright. Maybe they're leasing it.
Yeah.
And it doesn't tell you its precise market value either.
Okay, so existence is key, but not the whole story. What about documents?
Examining documents is also crucial. Looking at contracts or reading board meeting minutes provides direct evidence of agreements, key decisions, authorizations, things that have financial impact.
And what specific activities are involved in this inspection beyond just, looking? Is it just glancing?
It's more multifaceted than that. Inspection includes scanning, which is quickly looking through large data sets or ledgers for unusual items or significant entries that just kind of pop out.
Spotting outliers.
Exactly. It also includes scrutinizing, which is a more careful, detailed review of specific documents or records. And then there's reading, which means a thorough examination of critical documents.
Like those board minutes you mentioned.
Precisely. An auditor might scan general ledger accounts for surprisingly large or oddly described entries, which would then trigger a more detailed scrutiny or further investigation. And they definitely read critical documents like board minutes to understand key decisions made by the company's leadership, as these can have really significant financial implications.
And with everything being electronic now.
Good point. For massive volumes of electronic documents, auditors now extensively use text recognition programs. These tools can efficiently examine documents for key items, searching for specific keywords or phrases that might indicate a risk, a specific type of transaction, or maybe compliance with a policy.
So tech helps sift through the data flood.
It's essential. But the core principle remains. Examination and inspection is highly persuasive because it provides direct, first-hand evidence. The auditor sees it themselves.
That makes perfect sense. Direct observation or examination definitely gives a lot of confidence. Okay, let's move to the C in CARET, which stands for cutoff review. This one sounds like it's fundamentally about timing, making sure transactions land in the right accounting period.
Exactly right. The auditor performs a cutoff review of transactions that occur very close to the year end. We're talking the last few days of the old accounting year and the first few days of the new one.
Right around the dividing line.
Precisely. And this focuses on critical areas like inventory movements, cash receipts and disbursements, purchases, sales, and accruals, things that cross that year-end boundary.
And the purpose?
The primary purpose is crystal clear: to ensure that transactions are recorded in the correct accounting period. This is absolutely crucial.
Why is it so critical? What happens if the cutoff is wrong?
Well, think about it. If, for example, a major sale that actually occurred on January 5th of the new year is accidentally or intentionally recorded back on December 31st of the prior year,
Ah, I see.
it would distort the prior year's financial results. It would overstate that year's revenue and receivables. And conversely, it would understate the new year's figures.
So it's about making sure the financial snapshot, the balance sheet date,
Yeah.
captures everything up to that exact moment and nothing after, preventing timing errors from distorting performance.
Precisely. It prevents potentially material misstatements that can arise simply from incorrect timing. It ensures the integrity of period-over-period comparisons.
Got it. Now, the A in CARET brings us to analytical procedures. This is where auditors start looking for meaning in relationships and patterns within the numbers, right?
Yes, this is where the detective aspect really comes into play. It's a very powerful and strategic tool in the auditor's kit.
It sounds like where they can really spot anomalies that might indicate something is off, even if individual transactions look okay.
That's a great way to put it. Analytical procedures involve evaluating financial information by studying meaningful relationships among data. They are specifically designed to help auditors identify unusual fluctuations, trends, or patterns that might indicate errors, potentially fraudulent omissions, or even overstatements.
So looking for things that just don't look right compared to expectations.
Exactly. And beyond just trends over time, analytical procedures also check for internal consistency within a company's financial statements.
Internal consistency, like what?
Well, for instance, the net income reported on the income statement should logically flow through and agree with the change in retained earnings shown on the statement of retained earnings after accounting for dividends.
The statements should tie together.
They absolutely must. If those key numbers don't align, it's a significant red flag that requires immediate investigation.
And you mentioned scanning earlier under inspection. Can that also be an analytical procedure?
Yes, the act of scanning accounting records looking for large, significant, or unusual items using professional judgment is often considered a type of analytical procedure as well. It's using analysis to identify potential risks.
Okay. And you mentioned we'll dive deeper into this later.
We will, yes. We'll actually dedicate a good chunk of time later to substantive analytical procedures because they are such a significant area of auditing and deserve a more detailed exploration due to their strategic importance in detecting material misstatements.
Looking forward to that. Finding meaning in relationships. Fascinating stuff. Okay, the first R in CARET is for reperformance. This one implies the auditor actually does something themselves, independently, not just checking, but doing.
It does. Reperformance occurs when an auditor independently performs a procedure or control that was originally carried out by the entity's own internal control system.
Can you give an example?
Sure. Let's say a company's internal control system dictates that a specific manager must review and approve all purchase orders over, say, $10,000.
Okay, a control procedure.
Right. The auditor might take a sample of those purchase orders that fall into that category and independently perform that approval check themselves. They'd look at the documentation, see if the manager actually signed off, if it was the right manager, if it was timely.
So they're redoing the control step.
Exactly. The purpose of reperformance is to directly verify that the company's internal controls are operating effectively as designed. If the auditor performs the control and gets the same result or confirms the control was performed correctly by the company,
then it gives them confidence.
it adds significant confidence to the reliability of that process and the information it generates.
So it's not just checking the company's final work, but doing a part of the internal work again to confirm the system itself is functioning as intended. Very direct. The second, R in CARET, brings us to reconciliation.
Reconciliation.
This sounds like bringing two different stories or records into agreement, like balancing your checkbook against the bank statement.
That's an excellent everyday example. Reconciliation involves comparing financial amounts from two independent sources to ensure they agree.
Independent sources is key.
Absolutely key. The power comes from comparing the company's records to an external independent record. A classic and very common example in auditing is reconciling the physical count of inventory in the warehouse, what the auditor physically counts or observes being counted, with the company's perpetual inventory records, which is what the computer system says should be there.
And if they don't match?
Big problem. Or, as you said, reconciling the cash balance in the company's own books with the balance shown on the independent bank statement. You're comparing what the company claims it has with what an independent third party, the bank, says it has.
Makes sense. Any other examples?
Sure. It can also involve reconciling subsidiary ledgers, like a detailed list of all individual customer accounts, receivable balances, to the single aggregated general ledger control account amount for accounts receivable, making sure the detail adds up to the total.
And what does this procedure help prove?
Reconciliation helps to substantiate both the existence and the valuation of accounts. If the numbers from two independent sources match, it provides strong evidence that the amount exists and is likely valued correctly. If they don't match, it immediately flags an issue that needs investigation. Maybe theft, errors, timing differences.
That's a fundamental check for accuracy and validity. Then we have overshow for observation. This sounds like simply watching processes unfold, maybe less invasive.
It is quite literally watching. Observation is when an auditor directly looks at a process or procedure being performed by others.
Others meaning company employees.
Usually, yes. As with examination, this can be done by being physically present or increasingly through remote observation tools like video feeds.
What would they observe?
Well, for instance, early in an audit, an auditor might simply tour a client's facilities, walk around the factory floor or the warehouse, just to gain a general understanding of their business operations, see how things flow.
Get a feel for the place.
Exactly. Later, during more detailed testing, they might observe the client's employees taking the physical inventory count, as we just mentioned with reconciliation. This provides the auditor with direct first-hand knowledge of how processes are actually carried out in practice.
But I imagine there's a crucial limitation here. I mean, people might act differently when they know they're being watched, right? It's just human nature.
That's a critical point, and auditors are very aware of it. It's sometimes called the Hawthorne effect.
Ah,
While observation provides the auditor with direct personal knowledge, the evidence really only applies to the specific point in time it occurred. And yes, people might perform a process differently, maybe more carefully, maybe follow the rules more strictly, when they know an auditor is observing them.
so it might not represent how things usually happen?
It might not. So while observation is valuable for understanding processes and seeing controls in action, auditors must be aware of this limitation and always corroborate observations with other forms of evidence obtained through different procedures, like inspection or reperformance, that aren't affected by observation bias.
That's a clever insight into human behavior potentially affecting audit evidence. Okay, now to the T in carrot, tracing. We talked about vouching being backward directional testing. Is tracing the opposite? Confirming everything gets into the statements.
It is indeed the mirror image, directionally speaking. Like vouching, tracing is a directional testing method, but it moves in the opposite direction.
Forward instead of backward.
Exactly. Tracing starts with the original source documents, the initial evidence of an economic event. Think of a shipping document proving that goods actually left the warehouse for a sale, or perhaps a receiving report showing goods came in from a supplier.
The starting point of the transaction.
Right. And from that source document, the auditor follows the trail forward through the accounting system to the journal entries, the general ledger postings, and ultimately to the final financial statements.
And the objective here?
The objective of tracing is to provide assurance that all transactions or events that should have been recorded have indeed been given proper recognition in the company's books and records. It's primarily focused on detecting potential understatement errors.
Understatements. Making sure nothing got left out.
Precisely. Ensuring that nothing has been omitted, whether accidentally or intentionally hidden. For example, tracing from shipping documents ensures all goods shipped were actually invoiced and recorded as sales revenue.
So if vouching asks, is what's recorded real? Then tracing asks, is everything that happened actually recorded? They're two sides of the same coin when it comes to directional testing, just looking for different types of potential misstatements.
Exactly. One checks for overstatement, existence occurrence. The other checks for understatement, completeness. They complement each other perfectly in providing a rounded view.
Brilliant. Now moving on to the WARs part of our mnemonic. The W stands for walkthrough. This sounds like a comprehensive overview, like following a transaction's entire journey from start to finish.
That's precisely what it is. A walkthrough involves the auditor selecting one or a few transactions of a particular type and literally walking them through the company's processing system from their initiation all the way to their final reporting in the financial statements.
How do they do that?
It involves questioning the entity's personnel at various points in the process about their understanding of the prescribed procedures and the controls they perform. It's like asking, okay, you receive the customer order, what happens next? Who approves it? Where does the paperwork go?
So it combines several techniques.
It often does, yes. A walkthrough typically combines multiple techniques we've already discussed. Definitely inquiry, as the auditor asks staff about their roles and responsibilities. Often observation, as they watch parts of the process unfold in real time. Inspection of relevant documents and records at each stage. Sometimes recalculation to check mathematical accuracy along the way. And even reperformance of certain key controls to see if they function as intended within the flow.
Wow, that sounds really thorough.
It is. The purpose is to literally walk through a transaction's entire life cycle, understanding the flow of information, identifying key processing steps, assessing the design of controls, and confirming whether those controls have actually been implemented and are operating. It's a very holistic procedure for gaining a deep, practical understanding of a specific business process and its inherent risks and controls.
It's like building a detailed flowchart or mental map of the company's operational arteries for a specific transaction type. Very insightful. The A in WARS stands for auditing related accounts simultaneously. This seems like a smart way to be efficient and maybe gain deeper insights by connecting the dots.
It certainly is. Financial accounts are rarely isolated islands. They are inherently interconnected through the logic of double-entry bookkeeping and business operations.
Right. Everything links together.
Exactly. So auditors can be far more efficient and gain better insights by auditing certain related accounts at the same time, rather than looking at them in isolation weeks apart.
Can you give an example?
Sure. When auditing a company's long-term liabilities, like a significant bank loan,
Right.
it makes perfect sense to simultaneously audit the associated interest expense recorded on the income statement. These two numbers are intrinsically linked by the loan terms and the passage of time. If the interest expense looks wrong compared to the loan balance, it flags an issue in one or both accounts.
Checking the relationship makes sense. Any others?
Another common pairing is auditing capital additions to plant and equipment. New investments in long-term assets alongside the repairs and maintenance expenses. Why? Because there's a risk that companies might improperly capitalize expenses that should have been expensed to boost short-term profit, or vice versa. Looking at both together helps spot misclassifications.
I see. Or maybe investments in the income they generate.
Exactly. Auditing investments could be done alongside the dividend and interest income derived from those investments. This approach leverages the natural relationships within financial data, making the audit more holistic and, crucially, more efficient by allowing the auditor to connect the dots, corroborate information, and identify inconsistencies more easily.
That's a great example of working smarter, not just harder, by leveraging the underlying financial logic.
Yeah.
Okay, the next R in WARS is for representation letter. This sounds like a formal declaration from management, maybe near the end.
It is, and it happens right at the end. At the very conclusion of the fieldwork phase of an audit, after most of the evidence has been gathered and procedures performed, the independent auditor must obtain a management representation letter from the client.
Must obtain. So it's required.
Absolutely required by auditing standards. This is a formal written statement, typically on the client's letterhead, signed by senior management, usually the CEO and CFO.
And what does it say? What's its significance?
It serves several crucial purposes. First, it requires management to explicitly acknowledge their ultimate responsibility for the fair presentation of the financial statements they've prepared.
To putting it in writing.
Yes. Second, it serves to affirm that, to the best of their knowledge and belief, all necessary financial records, data, and other relevant information have been made available to the auditor, and that all material facts and transactions have been properly recorded and disclosed.
So they're confirming they haven't hidden anything important?
Essentially, yes. It's a critical piece of documentation because it legally underscores management's accountability for the financial information and documents their cooperation with the audit process. It doesn't replace other audit evidence, but it confirms management's stance on key matters.
So it's management formally signing off on their own claims about the numbers and their cooperation, taking that explicit responsibility. Makes sense. And finally, the S in WARS stands for Subsequent Events Review. This sounds like looking beyond the balance sheet date itself to events that happen after year-end but still matter.
That's exactly what it means. Auditors are required by standards to perform certain procedures, specifically looking for subsequent events. That is, events or transactions that occurred during the period after the balance sheet date, say after December 31st, but before the date the auditor actually issues their audit report, which might be weeks or even months later.
Why look after the year has ended? Isn't the audit about the year that just finished?
It is, but here's the key. Evidence that wasn't available at the exact year-end might become available before the audit is actually completed and the report is signed off. And this new information, even though it happened after year-end, can be crucial for making judgments about the valuation and presentation of assets and liabilities on the balance sheet date itself.
Okay. Can you give us a powerful example of how a subsequent event could impact a prior period's financials? That seems counterintuitive at first.
Certainly. Consider this common scenario. A company has a large accounts receivable balance from a major customer at December 31st. Then, in January, before the audit is finished, that major customer unexpectedly files for bankruptcy.
Okay, that's bad news.
It is. And that bankruptcy, even though it happened after year-end, might provide strong evidence that the customer's financial health was already deteriorating significantly bore December 31st.
It sheds light on the past condition.
Exactly. This new information could mean that the company's accounts receivable from that customer were actually impaired or uncollectible at year-end, requiring an adjustment to write down the receivable and recognize a loss in the year just ended.
So the subsequent event informs the valuation at the balance sheet date. Any other examples?
Sure, maybe the settlement of a pending lawsuit after year-end for a specific amount could confirm that a liability existed at year-end, requiring an adjustment to record or refine the estimated liability on the balance sheet. Or perhaps, if a company refinances a significant amount of short-term debt into long-term debt after year-end but before the report date, under certain conditions, that might allow them to classify the debt as long-term on the December 31st balance sheet.
Okay, I see. So while financial statements are a snapshot at a point in time,
Right.
events immediately following that snapshot can provide vital clues about the conditions at the time the snapshot was taken, ensuring the picture presented is as accurate and fairly stated as possible based on all available information before the audit concludes.
You've got it. It's about making sure the year-end picture reflects all knowable realities, even if the proof arrives a bit later.
Okay, wow. We've walked through the auditor's core toolkit, 5 carat wars, covering everything from fundamental math checks like footing and recalculation to asking questions with inquiry, proving existence with vouching, direct observation, checking timing with cutoff, using relationships in analytical procedures, redoing controls with reperformance, comparing independent sources with reconciliation, watching processes with observation, ensuring completeness with tracing, mapping processes with walkthroughs, linking accounts, getting management sign-off, and even looking after year-end with subsequent events. That's a lot.
It is a comprehensive toolkit built up over decades of practice and standardization. Each tool has its place and purpose.
So now that we understand these individual tools and their specific purposes, let's connect them to their overarching goal. How are they grouped and used for that critical primary objective, detecting material misstatements in the financial statements?
Right. This is where we talk about substantive procedures.
Substantive procedures. Okay.
These procedures are precisely what they sound like. They are designed to gather evidence about the substance of the accounts and transactions. Their specific aim is to find material misstatements, which are significant errors or omissions in the financial statements at the assertion level.
Assertion level. We touched on assertions briefly, like management's claims about the numbers.
Exactly. We'll delve much deeper into specific assertions shortly, but for now, think of them as management's implicit or explicit claims about the financial data they present. For example, when management shows inventory, $5 million on the balance sheet, they are implicitly asserting several things: that the inventory exists, that they own it, that it's valued correctly, not obsolete, and that the $5 million amount is complete, includes all inventory.
Got it.
Substantive procedures are the actions auditors take to directly test those claims or assertions.
And our source material tells us there are 2 main categories of these substantive procedures that auditors rely on. What are they?
That's right. They generally fall into 2 primary types. First, tests of details, and second, substantive analytical procedures.
Tests of details and substantive analytical procedures.
They both serve the same ultimate goal, detecting material misstatements, but they go about it in distinctly different, yet often complementary ways.
Okay, let's start with tests of details. This sounds like getting right into the granular evidence, looking at individual transactions and balances up close.
That's a very apt description. Tests of details are specific audit procedures used to gather direct, granular evidence supporting the individual account balances, the specific transactions flowing through those accounts, and the related disclosures shown in the financial statements. They are designed to dig into the individual line items and their underlying supporting documentation.
So how do auditors decide what to focus on when they're looking at all these details? I mean, large companies have millions of transactions. Do they look at every single one, or is there a more strategic approach?
Oh, definitely strategic. Testing every transaction is usually impossible and unnecessary. The approach depends fundamentally on the nature of the account being audited and the auditor's assessment of the risk of material misstatement associated with that account, often influenced by the strength of the company's internal controls.
Okay, so it varies. How?
Well, for accounts characterized by a high turnover rate, meaning lots and lots of similar transactions occurring during the year, like sales revenue in a retail company or cash receipts.
High volume stuff.
Exactly. For those high volume accounts, auditors generally concentrate their testing effort on the ending balance reported at year-end. This is especially efficient if the company's internal controls over processing those transactions are considered strong and reliable.
Why focus on the ending balance?
Because if the system processing those millions of transactions is working well, strong controls, the auditor can gain reasonable assurance by verifying the final output, the ending balance, perhaps through confirmations or analytical procedures, supplemented by some testing of the controls themselves. They essentially trust the system to handle the volume correctly, so they focus on validating the result.
Okay, that makes sense for high-volume accounts with good controls. But what about accounts that don't have a lot of activity? Where would they focus their tests of details there?
For accounts with relatively few transactions throughout the year, think of accounts like land or maybe treasury stock or complex long-term debt instruments which don't change very often. Auditors typically take an alternative approach.
What do they do?
They might focus on testing the details of each individual transaction that occurred during the year. Because there are simply fewer of them to examine, and each individual transaction could potentially be material on its own, it's feasible and necessary to examine each one.
So they tailor their approach based on the account's unique characteristics: volume, complexity, risk. And I imagine in practice, a combination of these methods is often most effective.
Absolutely. Very often, a combination of both approaches, testing the ending balance and testing individual transactions, is the most appropriate and effective strategy, especially for significant and complex accounts.
Can you give an example of that combination?
Sure. Let's go back to auditing a large sales revenue account. An auditor might first substantiate the reasonableness of the ending balance by performing substantive analytical procedures, looking at overall trends and comparing to budgets or industry data.
Big picture view.
Right. But they wouldn't stop there. They would also perform extensive tests of details on samples of individual sales transactions throughout the year and maybe related accounts like cash receipts and accounts receivable.
So both levels.
Yes. For instance, they might confirm a sample of year-end customer receivable balances, a test focusing on the ending balance, and also vouch a sample of individual sales entries recorded during the year back to shipping documents and customer orders, a test of the details of individual transactions. This dual approach provides more comprehensive evidence.
And what specific methods from our 5-Carat Wars toolkit do they primarily use when performing these tests of details? Which tools fit here?
Many of the core procedures we just discussed are integral components of tests of details. This definitely includes inspection of documents like invoices, contracts, sometimes observation of processes like inventory counts contributing to the balance, inquiry of personnel to understand specific transactions, direct confirmation with third parties like confirming receivables or cash balances, recalculation of amounts like checking invoice math or aged receivables, and sometimes reperformance of controls related to specific transactions.
So it's really applying those fundamental tools to get direct, granular evidence.
Exactly. This is where the auditor gets that direct, specific evidence needed to back up the numbers shown on the financial statements and ensure their accuracy, existence, and validity at a detailed level. It's the core of direct evidence gathering.
Now let's talk about the second main category of substantive procedures. Substantive Analytical Procedures, SAPs. We touched on analytical procedures earlier as part of the toolkit, but now we're diving deeper into their crucial strategic role, specifically as substantive tests designed to detect material misstatements.
Yes, this is a really significant and frankly increasingly powerful area in modern auditing, especially with the rise of data analytics capabilities. First, it's crucial to understand their overall role in the audit process. As we hinted, analytical procedures are always required by auditing standards at two specific crucial phases of all audits.
Always required. When?
They are mandatory during the initial planning stage of the audit and again during the final overall review stage just before the audit opinion is issued.
Okay, beginning and end.
Right. Now, in addition to these required uses, auditors may choose, and often do choose, to use them as substantive tests during the main testing phase of the audit, if they determine it's an effective and efficient way to gather evidence about specific account balances or classes of transactions.
So required for planning and final review, and optional but often used as a core testing method in the middle. Let's break that down. What's their core purpose during that initial planning stage? Why are they required then?
In the planning stage, analytical procedures play a vital role in helping the auditor gain a deeper understanding of the entity, its business, and its environment. By looking at preliminary financial trends, key ratios, and relationships compared to prior years or industry data.
What does that achieve?
It helps the auditor spot unusual fluctuations, unexpected patterns, or areas that seem inconsistent right from the start. This flags potential problem areas that might require more audit attention. So it serves a vital planning function. It helps the auditor assess risks of material misstatement, allocate audit resources more effectively, focusing effort where risks seem higher, design the nature, timing, and extent of other audit procedures, and even helps in determining appropriate materiality levels for the audit. It sets the stage.
Okay, risk assessment and planning. And then at the very end of the audit, in that mandatory final review, how do they contribute there?
At the final review stage, analytical procedures assist the auditor in forming an overall conclusion on the reasonableness of the account balances and the financial statements taken as a whole. It's like stepping back and looking at the big picture one last time.
A final sanity check.
Exactly. They help the auditor assess whether the conclusions reached throughout the entire audit seem logical and consistent, and ultimately assist in forming their final opinion on whether the financial statements, as adjusted, are free of material misstatement. It confirms that the final numbers tell a plausible story and hang together correctly before the audit report is issued.
Got it. So planning at the start, overall review at the end. Now, when do auditors choose to use them as a substantive test for specific accounts or transactions during the main audit phase, not just for planning or review?
Auditors choose to use SAPs as substantive tests when they believe these procedures can be a more effective or more efficient means of gathering the necessary audit evidence compared to performing extensive tests of details for a particular assertion.
More effective or efficient than tests of details. How?
Well, consider an account like, say, sales commission expense. If the company has a simple, stable commission structure, maybe a fixed percentage of sales and sales volume itself is reasonably predictable or verifiable,
Okay.
then an analytical procedure that calculates the expected commission expense based on the audited sale figures could be a very effective and efficient way to detect a significant misstatement in the commission expense account. It might be much faster than testing hundreds of individual commission payments.
If the relationship is strong and predictable.
Precisely. However, it's really important to note a key characteristic of evidence from SAPs. It's often considered circumstantial rather than direct proof.
Circumstantial. What does that mean in practice?
It means that while an SAP might strongly indicate that a misstatement exists, like if the calculated expected commission is way off from the recorded amount, it doesn't usually pinpoint the exact error or its cause. So additional corroborating evidence, often involving some tests of details or further inquiry, may still be needed to fully investigate the difference, understand its cause, and determine if it's truly a misstatement requiring adjustment.
That makes sense. It's a strong indicator, maybe points you in the right direction, but not always the final proof itself. What's the methodical approach auditors use for designing and performing these substantive analytical procedures effectively? Is there a process?
Yes. There's a clear, generally accepted 5-step process that ensures rigor and reliability when using SATs. Step 1 is determine suitability.
Suitability.
The auditor first decides which analytical procedures, if any, are suitable for testing specific management assertions related to particular accounts or transactions. This involves considering the nature of the assertion, the assessed risks of material misstatement, and any other tests of details already planned. If they're using advanced audit data analytics or ADAs, they also select the most appropriate ADA procedure, techniques, visualization tools, etc. for this specific audit objective.
So basically, matching the right analytical tool to the specific risk and assertion being tested. What's next?
Step 2 is critical. Evaluate data reliability. Before even thinking about developing an expectation of what the numbers should be, the auditor must rigorously evaluate the reliability of the underlying data they plan to use for the analysis.
Checking the source data quality.
Absolutely. Factors considered include the source of the information. Is it internal, external, from a system with good controls? They look at the comparability of the information. Is prior year data comparable after operational changes? They assess the nature and relevance of the information itself. And, importantly, they consider the effectiveness of the company's internal controls over how that information was prepared.
Because you can't draw reliable conclusions from unreliable data, right?
Right.
It's that garbage in, garbage out principle.
Precisely. If the underlying data is flawed, the analytical procedure built upon it will be meaningless or, worse, misleading. So data reliability assessment is non-negotiable.
Okay, suitability checked, data deemed reliable. What's step 3?
Step 3 is develop an expectation. This is where the auditor develops a reasonably precise expectation of what the recorded account balance or ratio should be before they actually look at the client's number.
An independent prediction. How do they develop that?
This expectation can be based on a variety of reliable sources, depending on what makes sense for the account. It could be based on historical financial information from comparable prior periods, adjusted for known changes. It might come from anticipated results based on the company's own budgets and forecasts, if deemed reliable. It could be derived from studying relationships among financial data within the current period, like gross margin trends. Sometimes it involves using relevant industry norms and benchmarks.
Comparing to peers.
Right. Or it might even involve relationships between financial and non-financial data.
Non-financial data. Like what?
Like predicting hotel revenue based on occupancy rates and average room rates. Or estimating payroll expense based on the number of employees and average salary levels. The goal here is to create a robust, independent estimate based on predictable relationships against which the company's actual recorded numbers will be compared.
Fascinating. So they build their own number first.
Yeah.
And then they perform the actual comparison that must be step 4.
Correct. Step 4 is perform and compare. The auditor performs the planned analytical procedures using the reliable data identified in Step 2, calculates their expected result based on Step 3, and then compares this expectation to the actual recorded amounts or ratios found in the client's financial records. This is the point where significant deviations, differences, or fluctuations become apparent.
And if there are significant differences, they don't just assume it's an error. They have to investigate further. That's step 5.
Exactly. Step 5 is investigate differences. If there are significant differences between the auditor's expectation and the client's actual results differences, exceeding what the auditor deems acceptable based on materiality and desired precision, the auditor must investigate the cause.
How do they investigate?
It typically starts with making inquiries of management to understand their perspective on the reasons for the difference. Management might offer plausible explanations, maybe a change in pricing strategy, a one-time event, increased competition.
But they don't just take management's word for it.
Definitely not. The crucial next step is to obtain sufficient appropriate corroborating evidence to support management's explanations. For instance, if management says gross profit margin decreased due to higher raw material costs, the auditor would need to obtain evidence like supplier invoices, purchase records, or independent market data to verify that explanation.
Verifying the story.
Right. And if management's explanations aren't satisfactory, or if the corroborating evidence doesn't support them, or if no explanation is forthcoming, the auditor must perform other audit procedures, usually more detailed tests, to resolve the discrepancy. This investigation might ultimately lead to the identification of a material misstatement requiring adjustment to the financial statements.
That 5-step process sounds incredibly logical and thorough. It seems like these SAPs can be really efficient when they work well. What factors contribute most to making these analytical procedures truly powerful and effective at actually detecting misstatements?
That's a great question. Several key factors really determine the efficiency and effectiveness of SAPs, and understanding them is crucial for auditors deciding when and how to use them strategically. First is the nature of the assertion being tested.
How does the assertion matter?
SAPs tend to be most effective for assertions where potential misstatements might not be obvious just from examining detailed individual pieces of evidence, or when such detail is simply unavailable or would be incredibly voluminous and costly to review entirely. Think about broad reasonableness checks or identifying unusual patterns across large data sets. They help auditors see the forest, not just the individual trees, spotting issues that might hide in plain sight if you're only looking at single transactions.
Okay, so good for big picture issues or things hidden in large volumes. What else?
Second, a really critical factor is the plausibility and predictability of the data relationship being used to form the expectation.
Plausibility and predictability.
Yes. For SAPs to provide appropriate assurance, the underlying relationships among the data must be plausible, meaning they make logical business sense, and, importantly, they must be predictable.
When are relationships more predictable?
Generally, relationships are more predictable in stable operating environments rather than highly dynamic or volatile ones. They're also typically more predictable for income statement accounts because these reflect activity over a period of time, like sales leading to cost of goods sold, compared to balance sheet accounts, which are just a snapshot at a point in time. And relationships tend to be more predictable for transactions that are less subject to management discretion or complex estimation.
Makes sense. Stable logical links. Is there a risk here?
Absolutely. A key caution is that data might appear to be related statistically when, in fact, they are not in a meaningful business sense, or the relationship might change unexpectedly. An auditor must have a clear understanding of the client's underlying business reality, its operations, and its industry to avoid drawing erroneous conclusions based on spurious correlations. Context is everything.
That's a good warning correlation. Doesn't automatically equal causation. And the underlying business context really matters. What's the third factor?
Third is the availability and reliability of data used. We touched on reliability in the 5 steps, but it's worth reemphasizing. The data used to develop the auditor's expectation must not only be available, but, crucially, highly reliable.
How is reliability enhanced?
Reliability is generally enhanced if the data comes from independent external sources, like industry statistics. If an internal data, reliability is higher if it comes from independent internal sources, meaning not generated by the department responsible for the amount being audited. Data generated under effective internal controls is more reliable. Data that was subject to audit testing in prior periods is more reliable. And data that comes from a variety of sources that can be cross-referenced and corroborated also increases reliability. Multiple reliable inputs lead to a more robust and reliable expectation.
Makes sense. Better ingredients make a better prediction. And the fourth factor, precision of the expectation, seems pretty intuitive. The more precise your prediction, the better it is at finding misstatements, right?
Absolutely. More precise expectations are significantly more effective in detecting misstatements. A vague expectation might only flag huge errors, while a precise one can detect smaller, yet still material, deviations.
How is precision achieved in practice?
Precision is generally achieved in 2 main ways. First, by developing the expectation at a sufficiently detailed or disaggregated level. For example, instead of analyzing total company sales, analyzing sales trends by individual product line, by geographic region, or even by major customer can provide a much more precise expectation and highlight issues hidden in the overall total.
Bringing it down.
Right. Second, precision is enhanced when the factors that significantly influence the relationship being analyzed are effectively identified and incorporated into the expectation model. For instance, if you're predicting utility costs for a factory, a precise expectation wouldn't just look at last year's cost. It would factor in known changes in production volumes, shifts in energy prices, maybe even significant weather pattern changes if heating cooling is a major component. The more relevant variables you accurately incorporate, the more precise the expectation becomes.
So it's about granularity and considering all the real-world drivers. Now, what about the different methods used to develop the auditor's expectation? You mentioned they vary. Are some inherently more precise than others? And when would an auditor choose one method over another?
Yes, definitely. Auditors employ a range of methods to develop expectations, and these methods vary significantly in the level of precision and assurance they typically provide. The choice depends on the data available, the predictability of the relationship, the assertion being tested, and the level of assurance the auditor needs. Let's start with the less precise methods.
Okay, the simpler ones first.
All right. First, there's trend analysis. This is probably the simplest form. It involves comparing a financial item or account balance from the current period directly with the amounts from comparable prior periods, looking for significant changes or deviations from the historical trend.
Just looking at history, when is this best used?
It's best used when the amount or relationship being analyzed is fairly predictable and the company's operations have been relatively stable over time. However, trend analysis generally provides only a low level of assurance because it's inherently less precise. It doesn't account for many changing factors, so it's often used early in the audit for risk assessment or perhaps in conjunction with other more robust procedures rather than as the sole substantive test.
Okay, good for a first look, maybe? What's another common one?
Another very common method is ratio analysis. Here, auditors calculate key financial ratios, things like gross profit margin, inventory turnover days, current ratio, debt-to-equity ratio based on known relationships between different financial statement accounts. They then compare these current period ratios to ratios from prior periods or perhaps to budgeted ratios or even to ratios of comparable companies within the same industry.
Comparing performance indicators, does breaking it down help here too?
Yes, similar to precision, analyzing ratio data at a disaggregated level, like calculating gross margin by individual product line or segment or inventory turnover by location, can significantly enhance the insights gained and the precision. But, like trend analysis, ratio analysis generally results in a relatively imprecise expectation on its own. It tells you if something changed, but often not why or by exactly how much it should have changed. So it also typically provides only a low level of assurance and is often used in conjunction with other audit procedures for corroboration or, again, for planning an overall review.
So trend and ratio analysis are good for a general overview, maybe for pointing to areas that need more investigation, but perhaps not precise enough on their own to provide the main evidence for a major account balance.
Precisely. For situations requiring higher precision and assurance, auditors employ more advanced, often quantitative methods. One is non-statistical predictive modeling.
Non-statistical predictive modeling, what does that involve?
This uses simpler, often common-sense predictive models to estimate a financial statement amount based on relationships with one or maybe a few key variables, often including operational or non-financial data. For instance, predicting hotel room revenue based on the number of rooms, average occupancy rates, and average daily room rates, or predicting royalty expense based on reported sales volume if the royalty is a fixed rate per unit sold.
So using known drivers to predict the financial outcome, how precise is this?
This method can provide a very high level of precision if the underlying relationship is very clear, direct, stable, and the data used for the variables, like occupancy rates or sale volume, is reliable and independently verifiable. In such cases, it might even be effective enough to be used as the principal or primary substantive procedure for testing that specific account or assertion.
Okay, potentially very powerful if the relationship is strong. What's the most advanced method mentioned?
That would likely be regression analysis. This is a sophisticated statistical technique that often uses historical data from multiple prior periods to develop a complex mathematical model to predict the value of an account balance or financial item in the current period.
Statistical modeling, how does it work?
Regression analysis can incorporate several independent variables simultaneously, allowing for a more robust and accurate prediction that accounts for multiple influencing factors. For example, a regression model predicting sales might include variables like advertising spend, pricing changes, competitor actions, and macroeconomic indicators.
Look at the advantages of regression.
Regression analysis offers significant advantages over simpler methods. First, the model development is explicit and mathematically objective. Second, it's generally very precise for forming an expectation, especially when based on stable historical patterns. Third, it allows for the inclusion of many independent variables, helping to control for various factors that influence the financial number being predicted. And fourth, it provides direct, quantitative measures of the statistical precision of the expectation itself, like confidence intervals, which helps the auditor objectively assess how much reliance to place on it.
Wow, that sounds like a really scientific way to model what should be there and then easily spot deviations. Can regression be the main test too?
Yes, absolutely. Like non-statistical predictive modeling, if properly designed and applied using reliable data, regression analysis can provide a very high level of precision and can often serve as the principal substantive procedure for an account or assertion, potentially reducing the need for extensive tests of details.
It seems like these more advanced analytical procedures require specific expertise and careful documentation. Are there special documentation requirements when they're used as the main test?
Yes, definitely. When an analytical procedure, especially a more complex one like regression or predictive modeling, is used as the principal substantive test for a significant financial statement assertion, auditing standards impose specific, rigorous documentation requirements.
What needs to be documented?
The auditor must document several key things in their work papers. First, their expectation and how it was developed, including the factors considered. Second, the results of the comparison of that expectation to the client's recorded amounts or ratios. Third, any additional audit procedures performed in response to significant unexplained differences identified during the investigation phase. Step 5. This detailed documentation ensures transparency, allows for supervisory review, provides support for the auditor's conclusions, and demonstrates accountability for the judgments made.
So, despite all this power and sophistication, do these substantive analytical procedures have any limitations? Or are they basically a perfect tool when used correctly?
No audit tool is perfect, and SAP certainly have limitations auditors must keep in mind. While incredibly powerful, differences or fluctuations identified through analytical procedures don't automatically mean there are errors or fraud. They simply indicate a need for further investigation.
So they raise questions, don't always provide the answer.
Exactly. Fluctuations can, and often do, result from legitimate business reasons, Maybe changes in the company's product mix, a new competitive pricing strategy, a one-time advertising campaign that boosted sales but lowered margins, changes in underlying economic conditions, or even just inherent differences between the client-specific operations and the industry norms used for comparison. An analytical procedure might also fail to detect a misstatement if it's masked by offsetting errors or if the expectation wasn't precise enough.
So the auditor needs to dig deeper to find the true cause.
Always. The auditor must determine the true cause of the fluctuation, which often requires corroborating inquiry with management and frequently necessitates performing some focused tests of details on the underlying transactions or components of the balance to get to the bottom of it. SAPs are a guide, not always the final destination.
And finally, you mentioned earlier that analytical procedures are required during the overall review stage of an audit right at the end. What's their critical role there in that final check?
Yes, this final overall review using analytical procedures is a mandatory step. It's typically performed by a senior member of the audit team, often a manager or partner, someone with comprehensive knowledge of the client's business, industry, and the results of the audit work performed.
And the purpose at this final stage?
The primary purpose here is multifaceted. It's to evaluate the overall financial statement presentation. Do the statements, after all audit adjustments, make sense holistically? It's to assess whether the conclusions reached during the entire audit are supported by the evidence gathered. And it helps the auditor form their ultimate opinion on whether the financial statements as a whole are free of material misstatement. It's that final, crucial, high-level sanity check.
Can new issues pop up even this late?
Sometimes, yes. During this final review, by looking at the latest numbers and relationships, the auditor might actually discover previously unrecognized, unusual balances, unexpected fluctuations, or potential fraud risks that weren't apparent earlier in the more detailed testing phases. If that happens, it might necessitate performing further audit procedures even at this late stage.
So they often update the analyses.
They'll often update the key ratios and data analytics that were used earlier in planning or substantive testing, using the final adjusted numbers to ensure the financial statements, as they are about to be issued, still make sense holistically, are internally consistent, and tell a coherent and plausible story. It's the final critical step before the audit report is signed and released.
Okay, that clarifies the multiple roles of analytical procedures throughout the audit. Now, we've explored the individual tools and how they combine into substantive procedures like tests of details and SAPs. Let's hone in again on a concept we mentioned earlier because it seems really fundamental: directional testing.
Yes, directional testing.
You said this is a crucial idea for understanding how auditors strategically target specific types of misstatements specifically, whether they're more worried about something being overstated or understated.
Directional testing is truly fundamental to how auditors think strategically about gathering evidence efficiently and effectively. It absolutely dictates the path the auditor takes when examining transactions and balances, and it directly correlates to the specific audit assertion, like existence or completeness they are trying to test. It's all about knowing where to start your test procedure to find a particular type of potential error.
And the two main components or directions of this testing are tracing and vouching, which we briefly touched on as part of the toolkit. Let's dig deeper into them now, really side by side, focusing on their strategic difference and purpose.
Yes, contrasting them makes the concept very clear. Let's start with tracing. As we discussed, tracing primarily tests for the assertion of completeness.
Completeness, making sure everything's included.
Right. This means the auditor starts their test with the original source documents, the initial evidence that an economic event actually occurred. Think of things like a batch of shipping documents proving that goods left the warehouse for sales, or maybe vendor invoices received proving that an expense was incurred.
The starting point, the real-world event evidence.
Exactly. The auditor selects a sample from this population of source documents and then traces forward from these documents through the company's internal accounting records, following the path to the relevant journal entries, then ensuring they were posted correctly to the general ledger, and finally confirming they are included in the financial statement totals.
Following the trail forward into the books.
Precisely. The objective is to confirm that everything that happened, as evidenced by the source document, was actually recorded in the company's books. This direction of testing is specifically designed to help find potential understatement errors. For instance, tracing from shipping documents helps ensure all goods that were shipped were actually invoiced and recorded as sales revenue. If they shipped something but didn't record the sale, that's an understatement of revenue, and tracing is designed to catch that.
So, tracing is like following a breadcrumb trail. From the real-world event itself, the source doc, to its final resting place in the financial statements, making sure nothing got lost, dropped, or deliberately hidden along the way. It protects against omissions?
Exactly. It ensures inclusion. Now, vouching goes in the complete opposite direction, and it primarily tests for the assertions of existence, for assets liabilities, or occurrence for transactions.
Existence or occurrence proving it's real.
Right. This procedure starts with an item that is already recorded in the financial statements, or the underlying ledgers, for example, selecting a sample of large balances from the accounts receivable listing, or picking specific revenue entries recorded in the sales journal.
Starting from the final number in the books.
Yes. The auditor then vouches backward from this recorded item to the original supporting documents. They go find the customer sales order, the corresponding shipping document, and the sales invoice related to that specific recorded receivable or revenue transaction.
Going backward to find the proof.
Correct. The objective here is to confirm that everything recorded actually exists or occurred. This direction of testing is primarily designed to help find potential overstatement errors, ensuring that the reported numbers weren't fictitious, duplicated, or improperly inflated. For example, vouching helps ensure that a listed receivable isn't from a fake customer, or that a large recorded expense actually happened and wasn't just made up to reduce profit.
Okay, our source material provides a really clear visual aid for this, doesn't it? It shows vouching going downward from the financial statements back to the source documents, testing existence occurrence, and tracing going upward from the source documents forward to the financial statements, testing completeness. That visual really clarifies the directional logic.
That visual is a superb way to conceptualize the flow. And building on that, there's a really key insight, a passkey from our source material that auditors constantly use as a mental shortcut. If an audit test starts with items already recorded in the financial statements, or the detailed ledger supporting them, the assertion being tested is most likely existence or occurrence. The auditor is actively searching for evidence that confirms the item is real and hasn't been improperly created or inflated by management.
Okay, start in the books, let test existence.
Conversely, if an audit test starts with source documents representing the population of actual events, it's most likely related to testing the completeness assertion. The goal then is to make sure all those events, as identified by the source documents, have been properly included and accounted for in the financial statements.
Start with source docs, test completeness. That distinction seems absolutely vital for auditors.
It is, because it fundamentally guides their entire testing strategy for different accounts and risks. It allows them to efficiently target the type of misstatement, overstatement, or understatement that is considered most likely for a particular account, based on incentives and past experience.
Can you give us another concrete example of this passkey directional logic in action? Maybe sticking with accounts receivable.
Certainly. When auditing accounts receivable, as we touched on, the auditor is usually most concerned about the risk of overstatement. Why? Because accounts receivable represent money owed to the company, an asset, and assets are generally more prone to being overstated, meaning the company might claim it's owed more money than it really is, perhaps to make its balance sheet look stronger or meet loan covenants.
Right. The incentive is to inflate assets.
Exactly. So following the directional testing logic for existence, the auditor typically starts their testing with the accounts receivable balance already reported on the balance sheet. They first verify that this total agrees to the supporting trial balance and the general ledger control account. Then, crucially, they select a sample of individual customer balances from the detailed subsidiary ledger, the list of who owes what.
Starting with the recorded balances.
Yes. And for each customer balance selected in the sample, they perform procedures that vouch backward to the underlying supporting documents, examining the related sales orders, shipping documents, and sales invoices to confirm that those specific sales actually occurred, the goods were shipped, and the receivable genuinely exists and pertains to that customer.
The backward flow to prove existence.
It's a clear backward flow designed specifically to confirm the existence of those reported receivables. It directly addresses the primary risk of overstatement, ensuring that the money the company claims it's owed is actually owed to it and resulted from legitimate transactions.
That truly drives home the strategic difference. It's not just about picking a procedure. It's about knowing what kind of error you're most likely looking for, overstatement versus understatement, and starting your investigation in the right place, financial statements versus source documents, to efficiently find it. Powerful concept. Okay, another procedure that seems incredibly powerful, especially because it involves getting information from outside the company, is external confirmation. Let's take a deeper look at that one.
Yes, external confirmation is a very important and widely used audit procedure precisely because it leverages independent third-party verification.
How is it formally defined? What makes something a true external confirmation?
Auditing standards define external confirmation as audit evidence that is obtained by the auditor as a direct written response from a third party, and the response comes directly to the auditor, not back through the client company.
Direct and written are key.
Absolutely. This response can be in traditional paper form, sent through the mail, or, increasingly common now, it can be in electronic format, perhaps via email from a verified address, or often through secure third-party confirmation platform websites where the third party logs in with access codes provided by the auditor to input or verify data.
So secure electronic methods count too.
Yeah.
What about just calling someone up?
That's a critical distinction. An oral response, like getting information over the phone, importantly, does not meet the formal definition of an external confirmation because it lacks that verifiable, written, or securely electronic attribute.
Good to know. What kinds of things do auditors typically confirm using this procedure? Is it just bank balances?
Bank balances are a very common example, yes. Confirmations are typically used to get representations about account balances like cash held at a bank, accounts receivable balances owed by customers, loan balances payable to lenders, or inventory held by third parties on consignment. They can also confirm specific transactions.
Balances and transactions. Anything else?
Yes, they can also be used effectively to confirm the specific terms of agreements or contracts, like the interest rate on a loan, payment terms, or restrictive covenants. And sometimes they're even used to confirm the absence of certain conditions, for example, asking about any undisclosed side agreements related to a sales contract that might affect revenue recognition.
Confirming what's not there too. Interesting. You mentioned the response comes directly to the auditor. Why is that so important?
Auditor control over the entire process is paramount to ensure the reliability and integrity of the confirmation evidence. The auditor must maintain strict control over the whole external confirmation process.
What does that control involve?
It involves several key steps that the auditor controls, not the client. First, the auditor determines exactly what information needs to be confirmed or requested based on the audit objectives and risks. Second, the auditor selects the appropriate third party or parties to send the confirmation request to. Third, the auditor carefully designs the confirmation requests themselves.
Designing the request. What goes into that?
Designing the request considers several factors. The specific assertions being addressed, like existence or valuation of receivables, the identified risks of material misstatement, including fraud risks, the layout and format of the request form, whether to use a positive or negative confirmation type, we'll discuss that, the auditor's prior experience with that client or industry, the planned communication method, paper versus electronic, ensuring management provides authorization for the third party to respond directly to the auditor, and considering the third party's likely ability and willingness to provide the requested information accurately.
A lot of thought goes into just asking the question properly, and the auditor sends them.
Yes, the fourth step is the auditor sends the request directly to the third parties, and also handles sending any follow-up requests if responses aren't received promptly. Maintaining control from start to finish prevents the client from intercepting or altering requests or responses.
Okay, you mentioned positive versus negative confirmations. What's the difference there?
That's a key distinction in how confirmations are designed. A positive confirmation is a request that requires the confirming party, the third party, to respond directly to the auditor in all circumstances. They have to respond whether they agree with the information provided in the request, like a stated account balance, or disagree, or if they need to provide the information themselves if it wasn't included.
So a response is always expected.
Yes, a response is always expected for a positive confirmation. Because of this, it generally generates a higher level of assurance, as non-response is clearly identifiable and requires follow-up.
Okay, what's a negative confirmation then?
A negative confirmation, on the other hand, is a request that asks the confirming party to respond directly to the auditor only if they disagree with the information presented in the request. If they agree, they are asked not to respond.
Only respond if it's wrong. That sounds less reliable.
It inherently provides less assurance, yes. Because no response to a negative confirmation could mean several things. It could mean the third party agrees with the information, or it could simply mean the request was never received, or it was received but ignored or misunderstood. You don't know for sure if silence means agreement.
So when would auditors ever use negative confirmations?
Because they provide less persuasive evidence, negative confirmations are generally used only in specific circumstances, typically when all of the following conditions are met. The assessed risk of material misstatement for the related accounts is low. A large number of small, homogeneous balances are involved. The auditor expects a very low exception rate, few disagreements, and the auditor has no reason to believe that the recipients of the requests are unlikely to give them consideration. Think maybe confirming small credit card balances or utility receivables. Positive confirmations are much more common for significant balances like large loans or major customer receivables.
Okay, that makes sense. Positive for higher risk assurance, negative only in specific low-risk situations. Now, what happens if management refuses to let the auditor send confirmations? Maybe they say it will upset their customers. That sounds like a potentially huge red flag for an auditor.
It absolutely is a significant red flag and requires careful handling by the auditor.
What's the auditor's response supposed to be if management refuses?
If management refuses to allow the auditor to perform external confirmation procedures for what the auditor considers a necessary test, the auditor must first inquire about the reasons for management's refusal and seek corroborating evidence regarding the validity and reasonableness of those reasons. Is it a legitimate concern, or are they trying to hide something?
Okay, understand the why. What next?
The auditor also needs to evaluate the implications of management's refusal on their overall assessment of the risks of material misstatement, including fraud risks. Does this refusal increase the assessed risk? And they need to consider the effect on the nature, extent, and timing of other audit procedures they might need to perform to compensate.
Can they just skip confirmation then?
If management refuses, the auditor must perform alternative audit procedures designed to obtain relevant and reliable audit evidence that the confirmations were intended to provide. For example, if they can't confirm receivables, they might examine subsequent cash receipts from those customers, inspect shipping documents and customer POs in more detail.
Trying to get similar evidence another way. But what if the refusal seems unreasonable, or the alternative procedures don't work?
This is where it gets serious. If the auditor concludes that management's refusal to allow confirmations is unreasonable, or if they are unable to obtain sufficient appropriate audit evidence through those alternative procedures,
Then what?
then the auditor must communicate this matter to those charged with governance, like the company's audit committee or board of directors. And, crucially, they must determine the implications for their audit and, ultimately, for their audit opinion. A scope limitation like this, imposed by management, could very likely lead to a modification of the audit opinion, either a qualified opinion or even a disclaimer of opinion, depending on the severity and pervasiveness. It's a serious issue.
Wow, so management can't just block a key procedure without consequences. Okay, assuming confirmations are sent, what about the results? What happens after the confirmations are sent out and responses start coming back?
Well, the first thing to consider is the reliability of responses. Even with written responses, auditors know that all confirmation responses carry some risk of interception, alteration, or even outright fraud. Someone could fake a response.
Really? How do auditors deal with that risk?
If an auditor has any reason to suspect that a response might not be reliable, maybe the return address looks odd, the signature is suspect, or the information seems inconsistent, they must perform procedures to dispel those doubts. For electronic responses, particularly emails, they might directly contact the purported confirming party by phone, using an independently verified number, to validate the sender's identity and the accuracy of the information provided. Using those secure, third-party confirmation platforms we mentioned earlier can significantly help mitigate these risks of interception or alteration.
Okay, validating the source. What about when they just don't get a response back, especially to a positive confirmation where one is expected? That's a confirmation non-response.
A non-response occurs exactly when a confirmation request sent is returned undelivered, like address unknown, or when the confirming party simply fails to respond or fails to fully respond to a positive confirmation request.
What does the auditor do then? Just give up on that one?
Oh no, absolutely not. The auditor may send additional confirmation requests, maybe try a different address or contact person if possible. But for every non-response to a positive confirmation request, the auditor must perform alternative audit procedures to obtain the evidence the confirmation was intended to provide. They cannot simply ignore non-responses.
Same alternative procedures as if management refused.
Often, yes. Similar procedures like examining subsequent cash collections, inspecting underlying documents, shipping docs, invoices, contracts, or verifying existence through other means. It's also worth noting that if the auditor experiences a higher than expected number of non-responses, that itself could be a red flag, potentially signaling a previously unidentified fraud risk factor. For example, maybe fictitious customers or balances that requires further investigation.
Interesting. What about those oral responses you mentioned earlier? If someone calls the auditor back instead of writing, does that count for anything?
As we noted, an oral response doesn't meet the definition of a formal external confirmation because it's not written or securely electronic. So it can't, on its own, provide the primary audit evidence the confirmation was seeking.
So it's useless.
Not entirely useless. If obtaining a written response isn't deemed strictly necessary to get sufficient evidence for a particular assertion, maybe it's a less critical item or other evidence is strong, the auditor might take the information received orally into consideration. However, if it relates to a non-response to a positive confirmation, the auditor would typically still need to perform those alternative procedures we discussed. The oral response might help guide those alternative procedures, but it doesn't replace them.
Okay, clear distinction. Now, what if a response is received, but it shows a difference? The third party says the balance is different from what the company's records show. These are called exceptions.
An exception is exactly that. A response that indicates a difference between the information the auditor was asking to be confirmed, which usually comes from the company's records, and the information provided by the confirming party.
What does the auditor do with exceptions?
This is critical. All exceptions must be investigated by the auditor. They need to determine the reason for the difference.
Why investigate every single one?
Because exceptions are potential indicators of problems. The investigation is crucial to determine if the difference points to a genuine material misstatement in the company's records, possibly due to error or even fraud. Or it might indicate deficiencies in the company's internal controls that allowed the discrepancy to occur.
So they could be errors, fraud, or control weaknesses. Are exceptions always bad news?
Not necessarily always misstatements. Importantly, some exceptions might simply be due to timing differences, like a payment made by the customer but not yet received or recorded by the company at the confirmation date. Or maybe measurement differences, like disputes over returned goods, or even simple clerical errors made by either the company or the confirming party. These types of differences, once understood and resolved, would typically not represent material misstatements in the financial statements. But the key is, the auditor has to investigate every exception to understand its nature and determine its implication. You can't assume it's just timing.
Right. Investigate first, then conclude. External confirmation seems like a really rigorous and important process for getting reliable, independent evidence.
It truly is one of the cornerstones of gathering persuasive audit evidence for many key accounts.
Okay, we've talked a lot about procedures like confirmation, vouching, tracing, and how they gather evidence. And we keep mentioning that they are designed to test assertions. So let's finally dive deep into what exactly are these financial statement assertions and why are they so fundamental to the whole audit process?
This is really getting to the heart of why auditors do what they do. Think of the financial statement assertions as the underlying claims, both explicit and implicit, that management makes when they present their company's financial statements.
The claims management is making about the numbers.
Exactly. When they put numbers and disclosures in the financial statements, they are asserting certain things about them. Auditors don't just audit the numbers themselves in a vacuum. They design their procedures specifically to gather evidence to test whether these underlying management claims, these assertions, hold up and are valid.
And why is this assertion framework so important? What purpose does it serve?
The financial statement assertions provide a clear, structured, and workable framework for the auditor to use when developing their detailed audit plan and designing their specific audit procedures. Every single procedure an auditor performs, as we've discussed, from confirming a bank balance to observing inventory counts to vouching a sales transaction, is ultimately designed to gather sufficient and appropriate evidence about one or more of these specific assertions. They break down the overall audit objective, or the financial statements fairly presented, into smaller, manageable, testable components. They give purpose and direction to every audit action.
Okay, breaking it down into testable claims. Our source material conveniently breaks these assertions down into two main categories, right? The first category relates to assertions about account balances and related disclosures at the period end. This applies mainly to the balance sheet accounts, assets, liabilities, and equity, and the related footnote disclosures.
That's correct. Assertions about account balances at a specific point in time.
And our source gives us another helpful mnemonic for these: CV ear up. Let's break down what each of these claims actually means for account balances and why auditors care so much about testing them. Let's start with C.
Right. CV ear up helps remember the key assertions for account balances. The C stands for completeness.
Completeness for balances. What does that mean?
This assertion asks the fundamental question: are all assets, liabilities, and equity interests that should have been recorded actually recorded in the balance sheet? And related to that, have all the appropriate disclosures for these balances been included in the footnotes? For example, has the company recorded all of its outstanding debt, including maybe informal obligations or guarantees? Or has it conveniently forgotten to include some liabilities to make its financial position look better?
Checking that nothing is missing.
Exactly. And there's a crucial passkey insight from our source material related specifically to testing the completeness of liabilities. Which way do you think the risk usually lies for liabilities? Overstatement or understatement?
Well, companies probably don't want to show more debt than they have to, so I'd guess the bigger risk is understatement liabilities being hidden or left out.
You got it. For liability balances, auditors generally focus more intensely on testing completeness, precisely because liabilities are far more prone to being understated, not fully recorded, than overstated. The incentives often push companies to minimize reported debt. So the auditor designs procedures specifically aimed at searching for unrecorded liabilities.
That makes perfect sense from a risk perspective.
Yeah.
Okay, what about the V in CVERRE?
The V stands for valuation, allocation, and accuracy. This is a multifaceted assertion asking: are the assets, liabilities, and equity interests included in the financial statements recorded at appropriate amounts in accordance with relevant accounting standards, like GAAP or IFRS? And are any resulting valuation or allocation adjustments, things like calculating depreciation expense for assets, establishing an allowance for doubtful accounts for receivables, or adjusting inventory to the lower of cost or market value correctly calculated, recorded, and disclosed?
So this is all about getting the numbers, the dollar amounts,
Yeah.
right? Ensuring they reflect fair value or appropriate cost according to the accounting rules.
Precisely. It's about the measurement and accuracy of the balances.
Then there's E for existence and occurrence. This sounds like the counterpoint to completeness, especially for assets. Is it asking if things are real?
It is exactly that. This assertion asks, do the assets, liabilities, and equity interests reported on the balance sheet actually exist at the given date? For instance, does the cash balance reported in the bank account truly exist? And is it actually available to the company? Does the inventory claimed on the books physically exist in the warehouse, and is it in usable condition? Do the machines listed as fixed assets actually exist, and are they operational?
Proving they're not just phantom assets.
Right. And the corresponding passkey insight here, as you suspected, is the opposite of completeness for liabilities. For asset balances, auditors generally focus more intensely on testing existence because assets are generally more prone to being overstated, recorded when they don't exist, like fictitious inventory or receivables, or maybe recording assets that have been disposed of, than understated. Companies might have an incentive to inflate their asset base to look financially stronger.
So, again, focusing the testing effort where the risk of misstatement due to incentives is highest. For assets, worry about things being made up, existence. For liabilities, worry about things being hidden or left out, completeness. That's a fundamentally practical distinction. What about the R in CVAP for rights and obligations?
This assertion addresses ownership and responsibility. It asks, does the entity truly hold or control the rights to the assets it reports? And are the liabilities reported genuinely the legal obligations of the entity? And is related information about rights and obligations appropriately disclosed in the footnotes?
Can you give an example?
Sure. If a company reports a building as an asset on its balance sheet, does it actually own the building, hold the rights, or is it perhaps merely leasing it under an operating lease, in which case it shouldn't be on the balance sheet as an owned asset? If they do own it, are there any liens or encumbrances against it that should be disclosed? Conversely, if a liability is reported, is it truly the company's obligation or maybe a guarantee for another entity's debt that needs specific disclosure? It's about confirming legal ownership and responsibility.
Okay, clarifying who owns what and who owes what. And finally, the UP in CVRPOP stands for Understandability of Presentation and Classification. This sounds like it's about the clarity and structure of the financial story being told.
It is. This assertion focuses on whether the financial information is presented and classified correctly in the financial statements themselves, and whether the related disclosures in the footnotes are clear, understandable, and comply with the relevant accounting framework's requirements.
What does that mean in practice?
It asks questions like, are assets and liabilities correctly classified as current versus non-current? Are significant accounting policies adequately described? Is the language used in the footnotes clear, concise, and unambiguous so that a reasonably informed user can understand the information being conveyed? Are related party transactions properly identified and disclosed? It ensures that the financial statements not only contain the right numbers, but also tell an understandable, compliant, and transparent story.
Got it. CV or up P for balances. Completeness, valuation allocation accuracy, existence, rights and obligations, and understandability of presentation. Now let's shift to the second category. Assertions about classes of transactions, events, and related disclosures for the period under audit. This looks more at the flow of economic activity over the period, things on the income statement like revenues and expenses, or cash flow items and their related disclosures.
Precisely. These assertions relate to the transactions and events that occurred during the period, not just the balances at the end.
And our source gives us a slightly different mnemonic here. COVUP. Similar letters, but maybe applied differently to transactions. Let's break this one down too, starting with C.
Right. COVU for transactions and events. The C again stands for completeness.
Completeness for transactions. How's that different from balances?
For transactions, this asks, have all transactions and events that occurred during the period and should have been recorded actually been recorded in the correct accounts? And have all related disclosures been made? For instance, have all operating expenses incurred during the period been recorded, or are some perhaps being intentionally omitted or improperly capitalized to inflate reported profits?
Again, checking that nothing relevant got left out of the transaction stream.
Exactly. And mirroring the liability insight, there's a corresponding passkey insight for testing the completeness of expense transactions. Where do you think the primary risk lies for expenses? Over or understatement?
Well, companies want to show higher profits, so they might be tempted to understate your expenses, right? Make costs look lower than they were.
Precisely. For expense transactions, auditors generally focus their testing efforts more on completeness because expenses are inherently more likely to be understated or omitted entirely than overstated. The incentive structure often pushes towards minimizing reported expenses. So the auditor designs procedures to search for unrecorded expenses, maybe by reviewing subsequent cash disbursements or analyzing relationships between expenses and operational data.
Another key area where understanding management incentives directs the audit focus. Okay, what's the O in COVUP? That wasn't in CVUP.
The O here stands for occurrence. It's closely related to existence for balances, but applied to transactions, it asks. Have the transactions and events that have been recorded actually occurred during the period, and do they genuinely pertain to the entity being audited?
So did the recorded transaction actually happen?
Yes. For instance, if a company records a large sale, did that sale actually happen? Was merchandise actually shipped? Did the service actually get rendered? And was it a sale by this company, or perhaps related to a subsidiary that should be accounted for differently? It tests whether recorded transactions are valid and not fictitious.
Got it. And there's likely a passkey for occurrence related to revenues.
There is, and it's the counterpoint to expense completeness. For revenue transactions, auditors generally focus their testing more intensely on occurrence or existence. Why? Because revenues are typically more susceptible to overstatement, recorded when they didn't actually happen, like fictitious sales, or recorded prematurely before they were earned, than understatement. The pressure to meet sales targets or show growth often creates an incentive to inflate revenue. So auditors design procedures like vouching sales back to shipping documents to confirm they actually occurred.
So for revenue, worry about it being made up, occurrence. For expenses, worry about it being left out, completeness. That's a really powerful way to remember the primary risks and the corresponding audit focus for the income statement.
Okay, what's the V in COVEP?
The V is again valuation, allocation, and accuracy, but applied to transactions and events.
How does that work for transactions?
It asks, are the monetary amounts and other data relating to the recorded transactions and events recorded and disclosed appropriately and accurately? For example, are sales recorded at the correct price according to the invoice and contract terms? Are quantities correct? Are foreign currency transactions translated at the right exchange rate? Are employee wages paid accurately calculated based on approved hours worked and correct pay rates? It's about the accuracy of the measurement and recording of the transaction details.
Ensuring the transaction amounts themselves are right. Then we have E in COVI-IP, which is cutoff. We saw this as a procedure, but it's also a fundamental assertion for transactions. Yes, cutoff is a crucial assertion specifically for transactions and events. It asks the simple but critical question: have transactions and events been recorded in the correct accounting period? This is all about ensuring proper timing around the period end, so revenues earned in December are recorded in December, not January, and expenses incurred in December are recorded in December, not November or January. It prevents the distortion of results across periods.
Got it. Timing is everything for cutoff. And finally, the UP in co-EView is, again, understandability of presentation and classification. How does this apply to transactions?
For transactions and events, this assertion asks, have transactions and events been recorded in the proper accounts according to the company's chart of accounts and relevant accounting standards? Is related information appropriately presented and described in the financial statements and footnotes? And are the disclosures clearly expressed and understandable?
Examples for transactions.
For example, are costs related to acquiring a new machine correctly capitalized as an asset, rather than being improperly expensed? Are research and development costs properly classified and expensed as required? Are unusual or non-recurring transactions appropriately segregated and disclosed so users aren't misled about ongoing operations? It ensures the transactions feeding into the financial statements are put in the right buckets and the resulting picture is clear and compliant.
Okay, co-VUPAD for transactions: completeness, occurrence, valuation allocation accuracy, cutoff, and understandability of presentation. So the so what of understanding all these detailed assertions, CVOB for balances, COVI for transactions, is really about how auditors actually match auditing procedures to specific assertions. This is where the rubber meets the road, right? Putting the toolkit, 5 carrot wars, to work strategically to gather evidence that directly addresses those fundamental management claims.
Exactly right. This is where the audit plan comes together. The financial statement assertions provide that powerful, systematic framework. While the specific audit procedures chosen for each significant account balance, class of transaction, and disclosure will vary significantly based on the unique circumstances of the client, their industry, the auditor's risk assessment, and the effectiveness of internal controls, the underlying purpose of every procedure is always to gather sufficient appropriate evidence about one or more of these specific assertions. The assertion dictates the objective of the test.
Can we quickly go through some examples of how specific procedures from our toolkit might be used to test specific assertions, just to make these connections really concrete for everyone? Let's start with completeness, ensuring everything is included. What kind of procedures would an auditor typically perform to test completeness, say, for expenses or liabilities?
Sure. For completeness, common procedures would include tracing transactions forward from source documents, like vendor invoices or receiving reports, into the accounting records and financial statements, as we discussed. They might also perform analytical review procedures specifically designed to identify possible omissions, like comparing current year expenses to prior years or budgets, and investigating significant decreases, or analyzing relationships like repairs expense relative to fixed assets to see if something seems too low. Observing processes and procedures like mail opening for unrecorded invoices can also provide evidence about completeness. And reviewing disbursements made after year-end can identify expenses that related to the audited period but weren't recorded.
Okay, tracing, analytics, observation, looking after year-end. What about cutoff? Ensuring transactions are recorded in the right time period around year-end.
Cutoff is primarily tested through specific cutoff procedures. This involves examining samples of transactions recorded shortly before and shortly after the year-end date for key areas like sales, purchases, cash receipts, and cash disbursements. For sales, they might examine shipping documents for goods shipped just before and after year-end and compare the shipping dates to the dates the sales were actually recorded to ensure they're in the correct period according to revenue recognition rules, like FOB shipping point or FOB destination. Similar tests are done for purchases by looking at receiving reports.
So very focused testing right around the period end date. How about valuation, allocation, and accuracy, getting the dollar amounts precisely right?
Auditors use several procedures here. Inspection of supporting documentation is key, comparing recorded amounts to invoices, contracts, or price lists. Basic math checks like footing, adding down, and cross-footing, adding across, detailed schedules supporting a balance ensures internal mathematical accuracy. Performing independent recalculations as crucial examples we mentioned include recalculating depreciation expense, recalculating the agent of accounts receivable to test the adequacy of the allowance for doubtful accounts, or independently verifying complex client estimates like warranty provisions or fair value measurements, and reconciliation of supporting subsidiary schedules, like the detailed listing of inventory items, to the general ledger control account ensures numerical agreement and supports the overall valuation.
Lots of calculation and comparison there. Now, for the crucial existence and occurrence assertions, proving something reported is real or actually happened, what are the go-to procedures for these?
Key procedures here are often confirmation directly with independent third parties, like confirming cash balances with banks or accounts receivable balances with customers. Getting that external validation is very strong evidence for existence. Direct observation and physical inspection examination of tangible assets, like attending the physical inventory count or inspecting fixed assets, provides highly persuasive, direct evidence of existence. And, as we discussed extensively, vouching transactions from the financial statements or ledgers back to the original supporting documents, like invoices, shipping documents, receiving reports, is the primary way to test the occurrence of recorded transactions and the existence represented by balances derived from them.
Confirmation, observation, inspection, and vouching the core test for, is it real? What about rights and obligations, confirming ownership of assets or responsibility for liabilities?
This assertion is often tested primarily through inspection of relevant legal documentation that supports transactions or balances. For assets, this might involve examining title deeds for property, vehicle registrations, or investment brokerage statements. For liabilities, it involves reviewing loan agreements, lease contracts, or bond indentures to understand the terms and confirm the entity's legal obligations. Reading minutes of board meetings might also reveal approvals or agreements related to significant rights or obligations.
So, digging into the legal paperwork. And finally, for understandability of presentation and classification, ensuring the financial statements are clear, properly classified, and comply with reporting rules.
Procedures here focus on the overall presentation and disclosure. Auditors perform inspection of the financial statements themselves and the accompanying footnotes, comparing them against the requirements of the applicable accounting framework, like GAAP or IFRS, using checklists or disclosure guides. They review all related disclosures for clarity, completeness, and compliance. They also perform inquiry of management regarding the rationale for specific classifications or the adequacy of disclosures for particular accounts and related party transactions. And they review how transactions were initially recorded, classification, to ensure they ended up in the proper accounts. It's about ensuring the final product is not only accurate but also clearly and transparently communicated according to the rules.
Okay, while you said this isn't a complete audit plan mapped out, it truly provides a powerful, systematic framework. It shows how auditors connect those individual tools from 5-carat wars directly to testing the fundamental claims CVR up and COVE up that management makes in their financial statements. It really ties everything together, from the specific action like vouching to the grand assertion like existence. It paints a picture of a very methodical and evidence-based process.
That's absolutely the goal. A logical, risk-based, evidence-driven approach designed to provide reasonable assurance about the fairness of the financial statements.
Wow, we have taken a truly illuminating deep dive today, haven't we? I feel like we've really peeled back the layers to reveal the meticulous, sometimes complex, but always strategic processes auditors use to ensure the integrity and trustworthiness of financial information.
It's been a thorough exploration for sure.
From the direct, independent verification power of external confirmations to the fundamental mathematical precision ensured by recalculations and footing. From the forward movement of tracing to catch those crucial understatements, ensuring completeness.
To the backward journey of vouching, designed to uncover potential overstatements by verifying existence and occurrence.
And the strategic insights that can be gleaned from performing insightful analytical procedures, looking for patterns and anomalies. It's crystal clear that auditing is a comprehensive, multifaceted discipline requiring both technical skill and critical judgment.
Indeed. And as we saw, it all really boils down to systematically gathering sufficient appropriate evidence to test management's assertions, those CVE or EP and COVE up claims about their financial data. The ultimate aim is ensuring everything presented is complete, accurate, actually exists or occurred, is properly valued and allocated, reflects true rights and obligations, is correctly classified, and is clearly presented and understandable.
It's a critical mechanism, isn't it? For maintaining trust and stability not just in financial reporting, but really, by extension, in our entire economic system. People rely on these audited numbers.
Absolutely. Understanding these procedures is far more than just learning about accounting debits and credits. It's truly about appreciating the rigorous framework that underpins and builds confidence in our economic interactions. This detailed, often unseen, behind-the-scenes work is precisely why we can generally rely on audited financial statements, whether they're from huge multi-billion-dollar global corporations or maybe just your local community bank or nonprofit.
It really is the bedrock of financial credibility, isn't it?
Yeah.
Allowing capital to flow more efficiently, investment decisions to be made with more confidence, and accountability to be maintained.
Well said. It provides that essential layer of assurance.
So, now that you, our listeners, have journeyed with us through the Auditor's Toolkit and seen firsthand how these intricate processes work, here's a thought to ponder. How might understanding these detailed, behind-the-scenes verification processes change your perspective the next time you encounter any piece of financial information?
That's a great question. Whether it's looking at a company's official earnings report, reading a news article, analyzing financial performance, evaluating a potential investment, or maybe even scrutinizing your own personal budget or a proposal at work.
What new questions might you ask now? Or what details might you scrutinize more closely, knowing the depth to which these figures can be examined and verified? Knowing about things like cutoff or completeness risk for expenses or existence risk for assets.
It's not just about accepting the numbers at face value anymore, perhaps. It's a powerful lesson in applied critical thinking and professional skepticism that really extends far beyond the formal audit world. It encourages a deeper questioning of the information presented to us.
A very empowering takeaway. We hope this deep dive has given you a newfound appreciation for the hidden depths, the rigorous methodology, and the critical importance of verification that lies behind everyday financial information.
It's been a pleasure diving into the details.
Until next time, keep exploring, keep questioning, and keep diving deep.